Okay, I'd like to thank you for purchasing the No BS Day Trading webinar. I think if you take the time to go through this material, you will find it to be well worth your time and money. And what I want to do right here on this first video is I just want to have a brief discussion on expectations. And the reason for this is everybody comes into trading with different ideas and different expectations, and they obviously have different expectations with regards to what they're going to get from the material that they purchase. Something like this, So a lot of people start out in this business the same way. They buy books and maybe buy a lower cost webinar or a lower cost course, and then maybe they buy higher price courses, or they spend some time making trades, and they try to make trades, and generally they lose. Sometimes you have a few winners, sometimes not. And so the reason I want to start the starter videos here with this particular video is because it's really important to keep a few things in mind and to have realistic expectations with regards to what you're going to get from this material. Okay? So the difference between this and most other things that you're going to find out there is that it's not that I'm coming at you saying, hey, this is the only way to trade, or this is the best way to trade necessarily, or that I'm a genius or something like that. That's not the case. It's that once you go through this, you're going to realize that what I'm showing you and teaching you is based purely on logic. It has nothing to do with the illusions or delusions or the misinformation that is constantly passed around in the trading world. And it sort of amazes me that that stuff is still out there, but it is. I mean, it's like nothing has changed in 100 years. Some quick background here. When I first started trading, we're going a long ways back now. I was probably like you, the viewer. I had read some books. I thought I knew a little bit something about trading. I had read the stories of multi-million-dollar traders, and my first trade was buying a stock that was like $3 a share. I thought I could pick up 1,000 shares of a $3 stock, and if it popped $1, I'd make some money. Of course, it didn't. And I fortunately for me, I always had somewhat of a risk control attitude anyway, so I lost 500 or 600, and then I tried it again, and I've lost again. And then I found the futures markets, and went, oh, I get even better leverage in the futures markets. That's awesome. So I opened up a futures account, and someone had talked about options, taught a course on options where, you don't have to worry about ever going deficit. You can just buy an option, and then you'll never lose more than you put into the market. So okay, that must be the answer. Let me buy an option. And I remember buying a Swiss franc option. That should tell you how far back we're going. And I bought a put option, and the market blew right through me, and I lost 70% of its value in no time at all. So held on to that one until it went to zero, and then finally I made the right call, and I bought a feeder cattle option, based off some chart pattern or whatever, and the feeder cattle market moved up, but it took it about 4 weeks to do so, and so feeder cattle went up like $1. And meanwhile, my option barely increased in value because I had a call option, but the time value had all expired on it. I had paid such a premium for it that I hardly made any money at all compared to the futures contract. So where I'm going with this is that we all start out the same way, generally. Unless you're just lucky and right out of the gate you come out of college and some firm hires you, or your dad or uncle works at a firm, or somebody knows you and they take you under their wing right away. But that's not how most people end up in this business. It's certainly not how I ended up in this business. And so where I'm going with all of this is that most of the stuff that's out there is pitched by people that don't really understand the markets. They really don't have the first clue as to what's happening in the markets. And even some of the guys that have a little bit of a clue, typically they end up getting somewhat lucky. And so they'll make a call. For example, earlier in this year, they make the call where they buy a little bit below 1,500 when the S&P is approaching 1,500, and then it cracks and it runs 100 points, and maybe they end up taking 70, 80 points out of the S&P, and maybe their risk was 10 points or 15 points or something. And so they think well, I got the call, all you got to do is risk 10 or 15, and then every now and then you'll hit 70, and I can have 30% winners, and blah, blah, blah. And of course, the next 5 times they try that maneuver, they lose. And they don't understand why. And so it's my hope to explain the why to you. That's the whole point, is I can't give you a magic key, and I can't give you the holy grail, but what I can do is I can show you exactly what's happening and give you the understanding as to why you're seeing what you're seeing, so that what you'll understand is why I make the trades. They're not based on some chart pattern or wave or moving average or something else. I make trades based on just a simple fact that I think someone else is going to buy or sell lower or higher than I do. I mean, that's all it really is. And that's the main thing to keep in mind. And so what you see up here is I have my video up of a YouTube video that I made. It's called my ES trade on the Jigsaw platform. And if you've not watched this video, I would highly recommend going to YouTube first and watching this video. It's ES trade on Jigsaw Trading DOM. You can just search it under No BS DayTrading. Really watch this video from start to finish. It not only explains the Jigsaw platform pretty well, but it explains this one trade setup that seems obvious, but the reason I used this setup for this sample was because it really illustrates a lot of the key points that I make throughout my material. And you can see it in action. So I say something in my material, and then you watch a video like this and you go, oh, okay, now that makes sense. Why, this is why I'm seeing what I'm seeing down here. And I would follow this video up with my other video, which is I recently posted, which is Scalping Legit. So, and right here I talk about size moving the market and big traders, how big traders approach the market. So if you haven't watched those 2 videos, I recommend doing it. I know most people watch all of my YouTube videos before they purchase the webinar, but some people don't. So if you've not seen those 2 videos, I recommend going ahead and watching those before you even get into this webinar material. It'll give you some background. Okay, I'm going to pause. Periodically, you're going to see me pause and restart the video. I'm going to pause for one moment. All right, so I brought up some notes. I have this included with the starter material that I include with the email whenever I respond to you after you purchase. And what I want to start with here is, expectations. What you get out of it is what you put into it sometimes. And what I mean by that is what I just explained, sometimes. If you're purchasing a course and the first thing the guy starts talking about is Fibonacci numbers, it doesn't matter how much effort you put into that. It's probably not going to help your trading because it's not based in reality. So that's one of the downsides, obviously, to all the trading material out there, is that much of it is just nonsense. And it's being pitched by guys who have either never traded or never really made any money trading, certainly don't understand what it's all about, and are into just pitching systems and whatnot. So with what you're about to go through here, it's not the same, because I can show you why things work and why they don't work. And another difference between, this material and a lot of other material is that I freely admit to you, I don't know what's going to happen all the time. There's a quote I've read a few times in several books, but, a trader basically says, every time I get in a trade, I assume I'm wrong. The market has to prove me right. So you go in really cautious, and you're always worried about the risk a little bit more than you're concerned about the reward. And you're trying to pick ideal spots for your entries and your exits. And so I'm the first person to tell you, I'm not going to sit here and say, okay, I'm going to buy, for example, or even what happened here, I'm not going to sell 97s and tell you, well, I know the market's going to go to 90. I mean, I don't know the market's going to go to 90. What I did think in this trade was that if we sold 97, the market would probably break to 96. I did think that, and I thought it would break pretty easily, but you never really know. And I freely admit that. There are times, though, when all the factors kind of line up, and you get the feeling, because you've seen it so many times before, okay, if they hit this, we should move at least 3, 4, 5 ticks. Above and beyond that, I don't really know. And you just sort of gauge it tick by tick at that point. So you're not looking to get into trades thinking that you're going to make 10 or 15 ticks in a trade. I mean, maybe you will every now and then. Maybe it'll happen for you, but that's not the idea of scalping. It's also not the idea of scalping to only take 1 tick. It's not like you necessarily want to just be in and out all day going for 1 tick. Sometimes that's all you can get, but in general, you're trying to, at least as a retail trader, you're trying to project 3 to 5 ticks out, 3 to 6 ticks out if you can. Sometimes it's not there to be had. And a lot of the HFT, the high frequency trading programs and algorithms, I mean, those programs are on the bid and offer all day long, but even those stack up sometimes and hold in one direction, as do your larger traders. So scalping is not about just taking 1 tick. It's about taking whatever you can get with minimal risk. That's really how I would define it. So moving on with these notes, basically, the number one goal of this webinar is to help you, understand the fundamentals of the game. Who is your competition and what exactly is happening? Who's going to hit the next price and why are they going to hit the next price? And then, does anybody need to do anything here or not? I should follow that up with. So, for example, in this particular setup, what happened was, if we go down these questions right here, okay, who is your competition and what's happening? Well, your competition is comprised of a bunch of other retail traders like yourself, but more so heavy day traders who are big scalpers who move, a couple hundred to a couple thousand contracts, and then your major banks, funds, and institutions that move anywhere from 1,000 to maybe 10 or 20,000 contracts. Those are the guys that really move the market. And so what you always have to be keeping in mind is, what is the size going to do next? And so, for example, right here, what I was seeing was, if I'm to ask those questions, let me pop this back up. We're at a point right here where I'm saying, okay, what exactly is happening? Well, what's happening is the market is approaching the low of the day. It's also approaching a big bid, that had been supporting the market. Okay, who's going to hit the next price and why are they going to hit it? Well, the market had been sitting above here and it had not been unable to rally much farther than 4 or 5 ticks past this, and just continually kind of ground down where it was sitting right above the big bid. So it would make sense in my mind that, well, if the sellers are holding just above this bid, they're probably going to hit the bid eventually. That brings us to our next question. Who's going to hit the next price and why are they going to hit it? A couple of reasons. One, you have sellers that are now attempting to move the market below the low of the day, right? So anybody who's getting short at 25, even 75, 50, 25, people who are getting short in this area are attempting to sell enough so that they can hold the market low enough to cause a chain reaction through the bottom of the day. Okay, that's the whole point. So if they're selling right here, if they're selling 98s, 97, 75s, and 97, 50s, then they know somebody has to sell 97. So if they're selling these prices, they're probably going to sell 97 and 96, 75 as well, because they need to start that chain reaction to the downside in order for them to get paid. This brings me to my next quick topic. Always understand, the only way you get paid on a trade is if somebody hits the next price. Period, period, period. The only reason someone's going to buy 97.25 is because they think someone else is going to bid 97.50 or higher. The only reason someone's going to sell 97s, the only reason I get short right here at 97 is because I think someone else is going to offer to sell 75s and 50s. That's it. So what you have to ask yourself is, okay, well, if I'm hitting this price, who's going to hit the 75s and the 50s, and why are they going to hit those prices? And this tops on the next question, which is, does anybody need to do anything here? Well, yes, people do need to do something here, and here's why. You might have some guys who have been long all day between 97.50 and maybe 99, let's say, somewhere in that area, some guys that were banking on this level holding the market up. And the market is now failing. So these guys are going to be trapped in long trades, and they don't know how far the market's going to go below if they crack this level. So what I think is, does anybody need to do anything here? Yes, I think that the long traders who are already in long positions will need to exit their long trades and puke out, as I call it. They will exit, bail out, puke out, and cover their longs for a loss. And they'll do that somewhere in this area because they don't want to watch the market drop away to 94 or 93. Better for them to cover at between 97 and 96 than to watch the market disintegrate another 8, 10, 12 ticks past that and take all that risk hoping that it comes back to their price. On the same note, does anybody need to do anything here? Absolutely. The guys who are holding this down, the short traders that I was just talking about, the guys who are being short right here, they need to sell this because they need to cause that chain reaction. They have to hit these prices in order to cause the long positions to puke out. In addition to that, they may have some guys like me, but maybe some guys that are of the same mindset as me, but they're swinging 100, 200, 300 contracts, are waiting for this to go. So now these short traders know, well, if they can just take out these prices, then your short-term day traders who are on the sidelines will come in and jump on board, hopefully. That's what they're hoping for. And you'll also have your long positions puking out for a loss. And that selling will continue to drive the market down. And when that selling drives the market down, these guys who are short will cover into that. And now they may cover instantly at 96.50 and 25, or they may cover at 95 or 94.25, whatever the case may be. But they're going to cover into that. And this is why you have so much choppiness. It's because it's one group trying to create a move, and then they cover into the move, and the market retraces back up. That's exactly what happens right here. So those are the questions. Understand what's happening. What's happening is that everybody is trying to give the shaft to everybody else. And I'm not trying to be crude or crass. It's like the easiest way for me to sum it up. You're trying to take advantage of another person. You're wagering money on an unforeseen outcome. And the only reason you're doing it is because you're trying to take it from somebody else, and they're trying to take it from you. And it's not a zero-sum game, it's a negative-sum game because you end up having all your costs involved with exchange fees, commissions, platforms, etc. So while the exchanges and the brokers and the platform providers are basically getting it from everybody, you and I and the other traders of the world are trying to take it from each other. And you can't move the market. All you can do is go with where you think the size is going to go. But I just want you to understand that's all that's happening. That's it. Period. End of story. Yes, are there some fundamental factors driving the market? Of course there are. Of course there are. But the only guys concerned about that are very long-term traders. And they don't really comprise a whole lot of the daily volume. Most of the daily volume is comprised of speculators. Guys doing shorter-term moves in and out all day long. Maybe a few guys making some swing trades for maybe a day or two. But that's where most of your volume is. And then, yes, you get your guys who commit to positions and they have open interest, and then they actually take delivery of the treasury bonds or take delivery of corn or beans or whatever the case may be. But that's not why most people are here. It's mostly just a poker game on a day-to-day basis. And what happens is something becomes a self-fulfilling prophecy. I mean, maybe there is some fundamental buying that would normally only take the market up 5 ticks if there were only, 5 guys playing. A few guys buy, a few guys sell. The buyers kind of overwhelm them by 5 ticks, and that's the end of the game. The day is over. What happens, though, because there's so many speculators and day traders, that buying can create an effect where fundamentally the market should probably only be 5 ticks higher, but it actually rallies 20 ticks higher over the course of the day because a bunch of people just continually get on board and buy it, and then you have short traders who get caught, and then they buy it to puke out, and they cause this move that has no basis in fundamental reality. But it's real because obviously people are making money and losing money, and that's all that's happening there. So try to keep that in mind as we progress through these videos. So that's kind of your first thing. Understand the fundamentals, and then who's going to hit the next price. And to go touch on this, does anybody need to do anything here? Right here they did. But at noon on a Wednesday with no economic data, let's say these markets, the treasuries, for example, over here, they're trading in a 3-tick range, and they've been in a 3-tick range for an hour. Who needs to do something? Nobody. Nobody needs to do anything. You're not going to have a puke out in either direction. Not everybody's going to hold tight. Unless some action comes in to really stimulate the market, nothing's going to happen. So if nobody needs to do anything, then why would you get involved? Because who's going to hit the next price? So for example, right here, let's say this is a slow day and you see the size. You've got 2,400 on the bid, 3,500 on the offer right above, and then 600 here. Why would you buy or sell in this scenario? I mean, who needs to buy the next price? Nobody. Who needs to sell the next price? Nobody. It's just the 3-tick market. As an example, I actually don't remember what happened with the treasuries right here, but it's having a reason for doing what you're doing. And if nobody has to do anything, then you don't need to be trying to do anything because no one's going to pay you. No one's going to pay up for it, and take the contract off your hands at a better price. So the next thing is realizing that size moves the market, be it paper, banks and funds, or locals, which are your big day traders, your HFT programs, or retail traders. 1,000 guys like you and I all buying a 5 lot at the same time, or a 10 lot or a 1 lot or whatever. So again, that just touches on the fact of it takes size to move the market. So right here, when this market goes, there's over 3,000 on the bid. So you have buyers who stack up to equate to 3,000. You got to have enough sellers willing to sell 3,000 contracts to drive the market through 97. That takes a lot. I'm not going to do it. You're not going to do it. So anytime you're stepping up in an area, you have to kind of figure in your head, is this a spot where it looks like size needs to do something? Is this an area where short sellers will gang up and actually sell 3,000, 4,000, 6,000 contracts and take this down, or is it not? Very important question, and that of course goes back to the video I mentioned right here, is scalping legit? So for more reference on that, I would suggest going to that video and watching it. Next, understanding market orders drive the market one way or the other. So it seems self-evident, but just so you get it very clear in your head, for this market to go down, market orders have to hit 97s. Right now you have a bid limit order at 97 and you have an offer limit order at 25, right? If those orders just sit there and nobody actually buys into the offer or sells into the bid, the market won't go anywhere. You've got to have the market order. So you have a limit bid at 97. I use a market order to enter. I actually hit into 97s and mark it in. And I know in order for the market to go down, another 3,000 contracts are going to have to market order into that. So where this becomes important is in places like this where you're looking for breakout trades, obviously. It also becomes important with reversals and pullbacks because you'll need to see the market backing up with market orders to help you identify spots where the move might be over and turning around. It's just extremely important. You have to understand you've got to have the market order. Same thing here. So if you've got 2,400 on the bid here and you've got 3,500 on the bid on the offer here, right here you're just going to have some market orders back and forth at 29. So you'll have some markets up, maybe it'll go bid, you'll have some markets down, maybe it'll go offer again. But to clear out these prices, somebody has to be willing to step up and buy 3,000, 2 or 3,000 at 29.5, or sell 2,000 at 28.5. I mean, market orders have to be there to drive the market. So it just goes back to understanding, does anybody need to do anything here? Is it slow or is it fast? Next, identifying pressure points. Prices where you anticipate low volume, areas where large orders are probably not resting. So what you're always looking for are preferably areas where you think there's not going to be a lot of volume moving the market in a certain area. And what I mean by that is right here, when I go short at 97, what I'm hoping is that there's probably going to be, I mean, I know there's probably going to be 3,000 at 97, maybe 2,500. I don't really know exactly, but I know it's going to be there. What I'm hoping is that these other orders give way fairly easily. So ideally, you would see only 800, 900, 1,000 trade at 75, and then again 1,000 trade at 50, and maybe 600 trade at 25. And then hopefully you wouldn't actually see 3, 4, 5,000 trade until lower. So you're looking for areas where the pressure can stack up and really punch the market very quickly. I'm going to pause one moment. All right, so it occurred to me I have I've done a video on Eurex products, and this video really helps me illustrate this point I'm trying to make. So it becomes very clear to you. Again, it doesn't matter what the product is; the concepts are exactly the same. So what you're looking at here, just so you understand real quick, you're looking at the bund on the left, the bobble here, the Euro stocks, and the DAX. And I'm not going to get into details about them. The important thing to watch right here is this. You have your cumulative volume right here, right? So when I talk about pressure points, identifying pressure points, what you're looking for is ideally, if you're going long in this scenario, you don't want to watch it take out 40 and 41 and then instantly trade 3,000 at 42. That's not what you're going for. You're going for kind of pressure points. So this is what I'm going to start the video so you can watch what happens. They're about to take out 40s here in the bund, and they're going to take out evens and ones here in the bobble. So watch how this plays out. I'll show you right there. Okay, so they trade 670 at 40. They trade 229 at 41, 395 at 42. Already printing some into 43s. Now by pressure point, here's what I mean, and this is the beauty of the Jigsaw platform also. They trade 476 up into 40. Only 11 print back down into that. As they take out the next price, they trade two. These are market orders. Again, so your market orders are coming in. 227 up into 41. Only a 2 lot trades back into 41. 374 up into 42. Only a 21 lot is printing back into 42. So you're having an overwhelming amount of blue with a very small amount of red. It's a pressure point. And that's what you're trying to identify really before you get into trades. You're trying to pick these spots where you think there's a pressure point where light volume can move the market. And so as the market continues here, and I end up pausing right there and explaining what I'm explaining now. Hold one moment. Okay, so to continue, the market pressed higher here, and it's not necessarily to watch what happens here for me to illustrate this point, but basically pressure point 40, 41, 42. Now at 43, 44, we saw instead of 229 and 413, we see 883 and 1,000, and now we're seeing 1,200 and 1,000. So now you're having more red and less blue. And maybe the market pulls back, maybe it doesn't, but the point is you're going for those pressure points. Same thing here in the bobble. What you can see is they trade 38.99 at 99, then they trade 726, 317, 652, and now it goes back up again to 1670. So you have these small pressure areas where it takes relatively light volume to move the market, and those are the ideal scenarios. That's what you're always trying to anticipate, because you want to be on board for those when they're just crushing the market one way or the other, and it doesn't take much volume to do it. That's how you get paid easily, and that's how you get paid fast. When you begin to see heavier volume come back in, that's a sign that you may be running into some resistance at that point. Market may continue, it may not, but the point is you want to be on board for the light volume areas. Okay, so back to our ES video on YouTube. And our next note, your next thing would be identifying puke out points, prices where losing traders will finally throw in the towel and give up on their trades. This is what helps to create the domino effect, right? So I discussed this right here. I figure that anybody who's long in this area between 97.50 and probably 99 in that area, they're going to puke out if it breaks 97. That's my anticipation. I could be wrong. I freely admit that. I could be wrong, but I just know from experience that most likely you're going to have some longs that are not going to want to be long anymore if this breaks. and hopefully their selling should help to carry the market down and create the domino effect. So I discussed that in the video quite a bit. Learning specific price action triggers, watching for icebergs, spoofs, aggressive market orders, etc. Very important. These are some of your key triggers for specific prices. In this situation, there was no spoof nor an iceberg. This is what I refer to as leaning on a price. And so I had a large order here of over 3,000 plus, which I felt was real. I felt most of the bid was probably real. It probably was not a spoof. And I figure everybody is leaning on that bid to hold up. And if it doesn't hold up, the market will break away. And so I use that though as my specific trigger. I actually wait until the market starts to print into that price. Once I see the market begin to print into that price, sure, it's possible I could sell 97s and the market could pop back to 97.50 or 75, and that's possible. But I just figure if enough contracts, even only 300-400 trade into 97, that'll be enough to trigger some more sell orders, and it should be enough to clear the market out. So you're always looking for specific price action to trigger your orders, because you're always trying to get the best price, whatever the case may be, on your entries and exits. And it's not always possible. Sometimes you have to sit back and you have to give a trade a little bit of room in order to justify the risk. But it is possible over time to really fine-tune those entries and exits and save yourself some ticks here and there, and it adds up over the course of the long term. Excuse me. Identifying good risk-to-reward points. Areas where you know you are wrong very quickly, so you can risk 2 or 3 ticks with the potential of making at least that much and hopefully more. The actual tick number will vary with the product. So in the S&P, it's a little bit different. You know, I've noticed that with the S&P, it's very hard sometimes to take trades where you're only risking 1 to 2 ticks. Much easier in the treasuries. This is why I'm a fan of the treasury markets. And you'll see the treasuries throughout these videos. That's why, because you're going to see there are a lot of points where you can pretty much know within a tick or two sometimes that you're wrong, particularly on fade trades. There are going to be some fade trades that you're going to see where you spot, or where I spot an iceberg and I join the iceberg, and I know the iceberg should hold. And if it does not hold up, I'm probably wrong, and I can bail with a 1 to 2 tick loss. Meanwhile, if I'm right, I'll definitely get 2 ticks out of the trade at least. And if I end up calling the point just right, I might get 4, 5, 6, 7 ticks out of the trade. So I've essentially increased my risk to reward from 1 to 1 to 2 to 1, possibly 3 to 1. Occasionally you get lucky and get 4 or 5 to 1. But you're always looking for a good risk to reward points. And this is why you don't get involved in the middle of the chop. For example, just looking at this particular market right here, you have a profile here of 85,000. You see this number right here? 85,000, 49,000, 47,000, 47,000, 22,000, right? 13, 10, and then the high. If you were to get involved right here at 29.5, there's no way to know you're wrong unless the market goes to new highs or goes below this level. I mean, you can't legitimately buy 29.5s and then just bail at 29 or 28.5, because the market could come right back to 29.5 because you're right in the middle of a choppy, very, very choppy area. Your real step doesn't happen until down here, and actually that's 109,000 right there. So really it's even below that. So what happens is you put yourself in a position where now if you buy 29.5s, okay, and I discussed this in different videos. I'm just kind of touching on this in the beginning to give you a rundown. You're having to risk at least 4, 5, maybe 5, 6 ticks to maybe make that on the upside. But for every tick you have to add on, it shortens your risk to reward. So now you're putting yourself in a position where you're pretty much risking 5 or 6 to maybe only be able to get 3, because if the market hits the high and stops, it's not going to go anywhere. So it's got to actually break highs for you to even get 1 to 1. In the same respect, if you sell 29.5s, you can't legitimately exit until the market breaks new highs. because it could easily bounce right back to 31 and then pull back into 29.5. So you're risking at least 4 ticks to 31.5, maybe 5 to evens. Again, you're risking 4 or 5 ticks in the hopes that the market will press back to a heavy volume profile area. So in order for you just to get 1-to-1, the market has to get back down to this area down here. You're always trying to keep your risk tighter than your reward, or keep it as minimal as possible, and hope that your payoff can be at least 1-to-1, if not greater. That's where you need to be. Next point, adhering to these risk points so you don't blow up in one day. If you're losing, you should be able to minimize the damage so one good day can eliminate 3 bad days, and not the opposite. You don't want to lose so much in one day or one bad day that it takes you 3 good days to make it back. Obviously, I mean, that's self-explanatory, but the point is, a lot of people fall into this trap. They end up having a string of bad days, and it may be due to the fact that they're not calling it right. I mean, maybe they're making bad decisions. Or maybe the market action just isn't very good. I mean, there are days like that where you get in, and every time you get a 1 or 2 tick winner, you keep thinking you can get paid and get 4 or 5 out of it, and you never do. So instead of taking your 1 or 2 tick winner, it becomes a scratch, 5 times, and there's just nothing to be had. So if you're having periods like that, the whole point is you want to keep those days small so that your loss is 1 tick, 2 ticks, 3 ticks. Because then you can have 3 or 4 days like that, but maybe you're only down 6 ticks over the course of 3 or 4 days, and then you have 1 good winning trade on the 4th or 5th day, and you make it all back in 1 good winning trade, and then you have 2 good days after that, and now you're net positive a decent amount, versus just continuing to fight and fight and fight when it's not there, and go on tilt and end up blowing up and dropping 12, 13 ticks in one day, and then doing it again the next day. And now you're down 20 plus ticks in 2 days. Even on a good day, your average good days may only be 8 or 10 ticks. So now it's going to take you 2, 3, 4, 5 days to get back what you lost in 2 days. A lot of people hit that trap. They can't cut themselves off, or they can't minimize the damage when they're off their game, or when things aren't going well. So that's an extremely important concept to keep in mind at all times. Next, realizing you cannot predict the next 20 tick run. Okay, so this is where short-term trading is, where you're essentially trying to risk nothing to make something. By that, I mean I'm always looking for the best price. I'm always trying to hit a price like this, actually. I'm hitting a price which I think is going to immediately go in my favor. I'm expecting to hit it and then have 3,000 more contracts trade behind me and have this go offer and instantly print 75 and never take any heat. That's not always realistic, and of course it doesn't happen at all whenever you're on the wrong side and you lose. But that is the goal. That's the goal of every pro scalper, every pro speculator on a day trading perspective, and that is what most HFT programs are trying to do. They are trying to get instant edge. You're going to hear me talk about edge a lot. That's exactly what they're going to try to do. They want to be first in line. They want to get it. They want to get the edge behind them, and they want to get a free look at the next price. So it's a big deal. Obviously, it's not going to work every time, but that's what you're trying to do every time. You're trying to look for those short-term trades where the market doesn't move against you. You basically take no heat, and you get something for nothing. So what's important to understand, like I said, is this is what the majority of day trading speculators are doing on a daily basis, as are the programs. If they are not going for more than a few ticks, and they're moving all the size, so i.e., if you have big speculators who are trading thousands of contracts out there in the market, and those guys are really only gauging for the next 2 to 5, 6 ticks out, the market's not just going to run away in one direction with no resistance on the other side. Hence the reason markets tend to range more frequently than they trend, right? So that's why. It's because guys are always going for the risk-free money. So if you know that the big traders are always going for the risk-free money and only kind of projecting 2 to 5 ticks out, and again, this goes back to, is scalping legit? definitely watch this video if you haven't seen it. Then what makes you think you know where the market's going more than they do? You know what I mean? And this is where I say this a couple times in various videos, but I'll say it here. Anybody who says they know where the market's going to be in an hour or the next 20 tick run is delusional or a liar, one or the other. Right here, what I can tell you is pretty certain the market will go from 97 to 96. And really, in this case, I thought it would go farther. I mean, I kind of had the idea it would go farther, but I didn't know. There's no way that I can know the market will go from 97 to 93 or 92 or 90. There's no way. There's absolutely no way I can know that. I have to be proven right. And so the way I approach these trades is I get in. If I'm proven right for 2 or 3 ticks, now I see what happens. Does it look like it's still going or not? Do I still have size behind me or not? If I think I do, I'll hold, and then maybe I can see another 2 or 3 ticks, and then I reassess again. If I think I still have size, I hold, and I keep holding until I think I've hit a wall. What happened in this trade was I was a little early getting out, but I immediately hit a wall, so it was very hard to judge whether or not I should hold the trade. The point is I need to be proven right constantly from tick to tick to tick. And I don't make the assumption, nor do I have a delusion that I know the market's going to run 8, 12, 15, 20 ticks. It's the same way the other way. No one can buy 97s here and tell you they know that the market's going to run to 1503. They just don't. It ends up, there's so many orders hitting the market at any given time. Unless you're the guy who's going to buy 25,000 contracts and run it up to 03, you don't know it's going to go there. And even then, even if you can buy 25,000 contracts, it's really possible that Goldman may be sitting there at 1,500 even with 15,000 contracts. So you end up buying, 10,000 contracts to get it up to 1,500. You run it up, and the next thing you know, you run into a wall at 1,500. Goldman's sitting there with 15,000. And so you buy 25,000 contracts and you still can't get it to go to 03. And in fact, it works against you because now people see that trade and now JP Morgan comes in and so does somebody else you've never heard of. And they join Goldman and start pushing the market back against you. So it's a constant back and forth and a constant battle where guys are trying to reassess at every tick. They are. All the major players are. And so that's why you have to be doing the same thing. Otherwise you get left behind. So don't be delusional. And this is the biggest one right here. Context is key. I cannot stress this enough. What you do at any given time depends on the context. There are no concrete rules. There are no set parameters. It all depends on the current action and what's happening right now. Okay, so for example, is there news or is there no news? You're going to trade differently on news than you do around no news. Is the action fast or slow? If it's fast, you want to be in. If it's slow, you don't want to be in. Is it 9 a.m.? Are there plenty of players ready to fire? So it's the same thing. I make this analogy of sitting down on the poker table. When a poker game starts, you have 8, 9 guys sit down, and they're all gung-ho and ready to win some money and ready to gamble. And so everybody is gambling it up, and they're putting their money in the pot. That's when you want to be playing in the game. When the money's flying and the chips are flying and guys are making bad decisions. Or is it 12:30 p.m.? Have the winners gone home? Are the losers now battling each other trying to break even? Same thing at the poker table. Everybody is gung-ho for the first 2-3 hours, and then come hour 4, a couple of guys have won a ton of money. They get up and leave. Now you've only got, instead of having 8 guys in the game, you've got 3 guys in the game, and the 3 of you are all trying to get your money back that you lost. Only there's no action because there's only 3 players. So, if it's 12:30 p.m., you can believe that anybody who hit it big between 9 and 11 a.m. has gone home. So you're going to lose that volume. And now you have a bunch of people sitting around hoping something happens in the afternoon. And occasionally, it's worth hanging around in the afternoon. Occasionally there's some action in the afternoon. But in general, it's different type of trading. And so it doesn't even have to be afternoon. That's my point. There's some days when you can come in and right away, by 9:30 a.m., nothing's going to happen. There's nothing happening. Markets deadlined or flatlined, and that you see that a lot in August and around the holidays. So if nothing's happening, going back again, does anybody need to do anything here? No, they don't. So neither do you. So turn off your computer and go do something else. Um, One moment. Okay, referencing some notes here. Before I move on real quick, just another brief word on predicting the market way out. I mean, I'm assuming you've bought this course, so you're pretty much sold on the idea of day trading and shorter term trading, scalping and whatnot. But just to kind of drive it home, you know, unfortunately, most of the people that are interviewed in like Market Wizards books and financial books and whatnot, they end up coming off as technical traders who have made a lot of money. You hear names like George Soros or Druckenmiller, who took over his fund, Richard Dennis and the Turtle Traders back in the 70s, whoever it may be, whoever the latest name is. I don't even keep up anymore. But so a lot of people get trapped into thinking, well, I mean, here's a guy who's running a fund, and I mean, he makes long-term calls, and he's making plenty of money. So where do you get off saying you can't predict the next 20-tick run or whatever? There's something you need to understand. And I explained this on my website, really, for inexperienced traders page, but I'll just sum it up real here because there's something I don't mention on that page, and it is, they're running huge, massive funds. They have all the time in the world. They're operating on the idea of not even having to make 100%. I mean, most of these guys, all they've got to do is beat the S&P. So if you end up raising 50 million or 100 million under management, if you can knock out 20-30% a year, it's considered pretty huge. And if you have a triple digit year, it's monstrous. I mean, you'll have so much money. If you have 100 million under management and you throw up a 100% return, you'll have 300 million under management the next year. And what most people don't know outside of the business is that these guys get a management fee as well. It's usually called 2 and 20. And what that means is they get 20% of any profits they make, and they get a 2% management fee. All right? So if a guy has 100 million under management, right off the top, he gets $2 million for a management fee. Now, yeah, granted, he has to get an office, and I mean, it's a big operation sometimes. You have an office, maybe you have some employees, but to be quite honest with you, it doesn't take much, because I know a guy who ran a $100 million fund, and he had himself and 2 other people there. And they had a small office, and his overhead wasn't much. His main overhead was that he was leasing a $10,000 a month apartment on the bay in Miami. Okay? So that was his overhead. Right off the top, they get that. So you've got $2 million off the top, and then they get 20% of any profit. So sure, I mean, you got $100 million under management. If you only make 20%, you make $20 million. That's another $4 million in your pocket. You can function on a different level, if you have that kind of money to work with. And some of these guys trade out of their house, these days. I mean, the speed's so fast, they'll have an office in their home, and that's what they're doing. So sure, in that scenario, maybe you can predict fundamentally some longer term calls, particularly with regards to like grain markets and livestock markets and whatnot. And maybe you can make some spreads, some calendar spreads or whatever, but you've got to have such a large bankroll to make it worth your time. It's just really not worth your time otherwise. Whereas it is possible to get chopped up in day trading, and it's possible to get ground down in commissions. You've always got to be careful about that. But at least it does provide you the daily opportunity to make a decent return on your money, and you can go on not triple-digit returns, but quadruple-digit returns. I mean, you can have 1,000% returns in a year. I'm certainly not saying that's going to happen to anybody who takes this webinar. Obviously, you read the disclaimer. I don't guarantee anything. But, it can happen without luck, basically. I mean, the luck is the action good? But if the action's good, or even decent, you can bang it out and make it worth your while. But that's the advantage. Otherwise, if you're not one of those guys, you can't be sitting there saying, I'm going to risk 10 ticks to make 40 ticks. It's just not going to work for you. You're never going to make it. You can forget about it. Never met a single trader who's made it that way outside of fund managers. Never met one. So there's there. So back to kind of the final point here. Context is key. And then what I have underneath that is it's not about one setup or one scenario or one step in the profile or a good risk to reward point. It's about all of it. It's 100% everything. You have to be reactionary and treat the market as a living organism, which changes its attitude, which I misspelled. Fix that on the video. It changes its attitude and behavior on a frequent basis. It's 100% everything, and I shared the story in a webinar. There's a bodybuilder named Dorian Yates, and somebody was asking him one time about, well, is it the size that you lift, or is it the amount of repetitions you do, or is it predominantly diet, or what? And he just looked at the guy and he says it's 100% everything. It's 100% diet, 100% correct amount of reps, 100% moving weight on the bar. 100% cardio. It's all of it. You got to understand all of it to make it happen. And trading is the same way. You have to understand all of it because the context really is the key. Because there are going to be times when you're not going to do something. That's really where experience comes into play. So, for example, there may be a different day where the action is different, where I see a bid of 3,000, and I don't want to sell it. Because the context is different. I don't think it's going to be a puke out point. I don't think sellers are going to carry it through. It's a different day where just something there was no news or anything, and it just happens to be 3,000 on the bid there, and it's probably only going to go one tick below and then come back to 97 or not, 97.25. So it's all about understanding the big picture and the context. And this is why I stress so much on the fundamentals of understanding the game itself. You have to have a good grasp of the game to make better decisions and to realize when you should and should not be firing. And this is something that's hard for me to convey to you. As a educator, I have a lot more experience than you do at this, and I've been around this for years. So when I'm teaching, sometimes what happens is, a person will say, well, we're at a step in the profile, why aren't you playing the breakout? Or we're in a step in the profile, why aren't you thinking it's going to go back in? For example, even right here. Okay, you're at a step between 47,000 and 22,000. And that's a fairly decent step in the profile. A brand new novice trader will look at that and say, okay, well, are you going to buy 29 halves and expect it to go to 31? Or, are you going to buy 30 thinking it's going to break out? And I'm going to say no. Okay, well then are you going to sell at 29 halves and wait for it to pull back into 28, 27 half? And I say no. And he says, then what the hell are you doing here? And the answer is, I'm not doing anything here. The reason is because the context is wrong. The context is wrong to do either one of those trades because I'm not expecting a breakout to the upside. I don't think the market, there will be enough pressure to make that happen, nor do I think there will be enough pressure to make it press down anytime soon. I'm going for those pressure points, for that easy, fast, free money, which is what you're going to see, over here on this trade. That's what I'm going for. I'm not going to play just because I'm at a step in the profile. A step in the profile is irrelevant if the market's dead and I don't have any anticipation for what's going to happen next. I have to be, anticipating what's coming next. And that comes with experience, a large amount of experience. But you'll get there. You'll get there if you stick with it, and you'll get there if you listen to what I'm talking about with always be asking who's going to hit the next price. Does anybody need to do anything here? So for example, in the treasuries right there, I wouldn't be looking to do anything, but I'm over here in the ES plan because I think the ES is going to break. So right there I get short. You can see it light up 97. They end up, this is the actual video itself, and I'm showing people what's happening. I show them I'm getting short a 5 lot. So I turn it back on. I demonstrate that I see some size trading into that. Right there, it starts to trade, and then right there it goes. Now see, pressure point. That's what you're looking for. I mean, if I could find one trade a day like this, even if it's only good for 2 or 3 ticks, that's really the goal. I mean, that's what you're going for. Hopefully you find more trades than that, but what I'm saying is that's the goal. You pick that pressure point where you think you're on the right side and you think the market should instantly move, and it does. They trade 3,300 there. They instantly trade 3,000 here, and they're already printing 545 down. And unfortunately, what happened in this trade was right away I run into a wall, which is totally not what I want to see. I do end up scalping 3 ticks out of the trade, but that's the ideal scenario. So it's context. I see a market that I think is going to break the lows. I think it will be a puke out point. I think new short money will jump on board, and I think I will be able to get the edge very fast, and the market will be at a pressure point that moves in my favor very fast, and I'm going for quick, easy, fast money on volume moving it and activity moving it. And I'm not going to play, for example, if the market was trading up between 99 and 1501, and now we're at 1500, I'm not just going to buy or sell 1500s just because. There has to be a reasoning there behind it. So profile step, no profile step, iceberg, no iceberg, whatever the case may be, you have to take it into context. And this is where the screen time is going to help you as the months go by. You're going to have to put a lot of commitment into this. And what I tell people is this too. I'm up front. You don't have to take any course to make it trading. The problem most people run into is that they're looking at the wrong things right from the start. So that's why most people fail. Most people fail because they're looking at charts, indicators, and nonsense. That's what they're looking at. So they're not even looking at volume. Even if they start trying to look at volume, they have a terrible depth of market platform. So they're not seeing the volume very well. Most people aren't even on the majors. I mean, Jigsaw is up and coming right here, and it's on its way up. And I definitely foresee Jigsaw having a bright future in the next several years. The company, but even prior to Jigsaw, like CQG and TT's X Trader. If you walked into any professional trading firm in the world, what you see are desks and desks of TT's X Trader. That's what you see. That's what everybody's on. That's what everybody uses. Because it was the best. It was the fastest. It flowed the best. And it had some features that were just easier to follow. It's definitely better than CQG. CQG was probably next to it. And then CTS came along and it was pretty decent as well. But most traders get out there and they're trying to keep their costs down, and so they're not willing to kick down the money for those platforms like that. So they've never even seen good volume. And here along comes Jigsaw and Peter and Ian, and they're offering this product for $400 one-time purchase right now, and $50 a month for the order placement feature. It's a bargain beyond belief. I can't even describe it, and it's most likely going to go up in the future. They're not worried about it right now, but it probably is. And I'm telling you right now, and it's not me pitching. Like, I don't get any kickback from Peter. We swap customers. I mean, if someone comes to me, I'm like, gotta look at Jigsaw. If someone comes to him, he's like, hey, if you're interested in scalping, go check out John's website. It might be for you, might not. But what I'm telling you right now is this is the dynamite platform to have right now. It's the best. And what you're going to find out, or what we're going to see, is you're going to see companies picking up Jigsaw, or, unfortunately what may happen is like TT and CQG are going to start incorporating the same idea of splitting the uptick, downtick data and your time and sales. It's going to catch on. So right now, guys that are using Jigsaw have a tremendous edge over people who do not have Jigsaw. Doesn't mean you're going to make money, obviously, but it's just a big, big, big edge to have. And so in the next few years, as this idea catches on, your competition is probably going to become a bit more fierce because everybody's going to be seeing this. Even your basic local, retail traders. it matters. You know, it obviously matters because you can see icebergs and whatnot, and maybe 50 other guys out there can't see the iceberg, so they're not making the same trade that you're trying to make at the same time. You know, most big traders can see the majority of this. They either have their own front end or they're on TT. But even being on TT is not, I'm telling you, it's not as good as this platform. There's things you'll spot on Jigsaw that you would miss on TT. So it's just a really excellent platform. But to finish up on this video, and where I was saying, what I was going with I digressed a bit, but with regards to you taking a course or not taking a course or whatever, once you start looking at order flow, I mean, if you were to just turn on your screens and put up your depth of markets and get Jigsaw and watch Jigsaw for the next several years, most likely you would figure it out. I mean, you almost have to figure it out at some point. It's not that you can't figure it out on your own. It's that now that you're going in the right direction and you're watching the depth of market, taking this course will shave a lot of time off your learning curve. You'll begin to learn the importance of icebergs, aggressive market orders, identifying proper risk to reward points, you know, knowing when to save ticks. All these little things that add up, you're going to get that right here, right now. And so it won't take you a year or a year and a half to figure out, I got to pay attention to an iceberg order. You know what I mean? Stuff like that. Just, it won't take as long to figure out because I can shave time off for you. Above and beyond that, once you go through the material, you've obviously got to sit down and you got to get in the game. You know, my advice is go through all this material, maybe 2 or 3 times, and then get in one lot and start firing. You know, don't sim trade very much. I mean, sim trading is not real at all. So you won't manage winners or losers the same way as you will real trades. So get in the game, open an account, get in one lot, start firing. After you go through everything, of course, and you get somewhat of a better, decent idea of your own game plan. And, you know, part of this course too is, you know, take these concepts and make them your own. Figure out how you can apply certain ideas to your own patterns of trading, your own styles of trading. There may be trades you would take that I would not trade. There would be probably be trades that I would take that you would not take. We're all looking at our own information, but we're looking at the same information, trying to make a judgment call on that. And so we don't trade the same, but we kind of do trade the same. You know, everybody's looking for the edge. Everybody's looking for that trade that never goes against them. You take no heat for instant money. Sometimes it's there, sometimes it's not there. And, you know, with regards to context, just to give you 2 quick analogies, I was reading a poker book when I was much younger, written by a guy named Doyle Brunson. He was a World Series champion back in the day. And someone asked him, you know, well, how do you play this hand in this situation? And he said, well, it depends. And I'm like, what do you mean it depends? And he said, well, it depends on the situation. He goes, you know, you have to understand your opponent. You have to adjust from hand to hand. You might have the same exact hand with the same exact flop, talking about Texas Hold'em, against the same exact opponent. But there will be some times when the proper course of action is to raise, sometimes when it's to check, sometimes when it's to fold. You know, sometimes bluff, sometimes not bluff, because it all depends on what's happening right then, right now, at that moment in time. For no one, you know, guys who don't play poker, maybe you go for like a baseball analogy. I mean, you're going to have the same pitcher and the same batters playing each other over and over again throughout the years. But the pitch that pitcher decides to pitch at any given moment depends on what's happening right now. He's trying to psych out the batter right now, and the batter's trying to get into the head of the pitcher right now and figure out what's this guy going to throw. You know, he knows I suck at fastballs, so is he going to throw a fastball, or is he going to try and fake me out and throw something else? It's just this constant back and forth battle in the moment, and that's why I'm stressing you've always got to be, you know, looking at what's happening right now in caps. You know, I'll put it in there. You have to be very reactionary. And so to finish off this first intro vid, I'm going to leave you with a quote from Bruce Lee, and I won't read through it. You can watch it, but I have it on here, and I dug it up on YouTube. If you go to YouTube and just search for Bruce Lee, be like water, my friend, or just plug in this URL right here. Yeah, you can see it up top. He gives this really great quote, and it basically refers to the various forms that water is formless, essentially, and water can flow, water can crash, and all this good Bruce Lee martial arts Zen stuff. That sounds funny, but yet it's really a great analogy, and it's a great analogy for life in general. And he finishes with "be like water," and that's what I tell people when they're trading. It's don't have an opinion that you get hung up on. Don't assume anything, and don't think that you can know what's going to happen pretty much more than the next 2 or 3 ticks out. Just go with it. React to what you're seeing, and you will make better decisions in the long run. All right, so on to the next video.